Preparing for a P&G Finance Manager interview questions and answers interview, you've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does finance leadership mean to you at P&G? At P&G, finance is a business partner, not simply a reporting function. I would connect financial results to consumer demand, brand strength, pricing, innovation, productivity, and cash generation. In a finance manager role, I would translate strategy into forecasts, challenge assumptions constructively, and help leaders make choices across marketing, supply chain, and customer investments. Strong performance means sustainable growth, healthy margins, disciplined spending, and reliable stewardship. While answering, focus on finance as a commercial partner, connecting consumer demand, brand investment, productivity, cash generation, ethical judgment, and long-term shareholder value rather than describing finance as only reporting and control. Question 2. Why do you want to work for P&G as a finance manager? I want P&G because it combines exceptional brands with rigorous, fact-based management. The scale would expose me to pricing, innovation, supply chain, customer negotiations, and international complexity, while the finance role remains close to real business decisions. I am also attracted to P&G's reputation for developing leaders and holding people accountable for both results and integrity. I would bring analytical discipline, curiosity, and a strong bias toward actionable recommendations. Make sure to cover P&G's portfolio of trusted brands, scale, operating discipline, consumer focus, leadership development, and the opportunity to influence commercial decisions while demonstrating that your motivation extends beyond brand recognition. Question 3. How would you evaluate the performance of a P&G brand? I would start with sales growth, then decompose it into volume, pricing, mix, distribution, and foreign exchange. I would compare those drivers with category growth and market share because growth below the market may signal competitive weakness. Next, I would assess gross margin, trade spending, advertising effectiveness, operating profit, and cash generation. Finally, I would test sustainability by reviewing consumer trends, innovation pipeline, retailer support, and whether recent gains came from temporary promotions. In your answer, talk about volume, price, mix, market share, household penetration, distribution, gross margin, marketing effectiveness, retailer economics, cash conversion, and separating temporary effects from sustainable brand momentum. Question 4. Walk me through how you would build an annual operating plan. I would begin with strategic priorities and a fact-based baseline, then build assumptions for volume, pricing, mix, market growth, innovation, marketing, input costs, productivity, headcount, and foreign exchange. I would involve commercial and supply leaders early so the plan reflects operational reality. After consolidating the model, I would challenge gaps, quantify risks and opportunities, and present scenarios. The final plan should be ambitious, internally consistent, measurable, and linked to cash generation. Be sure to mention strategic objectives, baseline performance, volume and price assumptions, category outlook, marketing and innovation plans, cost inflation, productivity, headcount, cash, risks, scenarios, and alignment with business owners. Question 5. How would you explain a significant variance between actual and forecast results? I would first establish the variance bridge against the latest forecast, separating volume, price, mix, foreign exchange, input costs, productivity, spending, timing, and one-time items. I would validate each driver with commercial and operations partners rather than relying solely on accounting data. Then I would determine whether the variance reflects an outdated assumption or execution issue. I would update the outlook, assign actions, and communicate both the financial impact and the underlying business lesson. Focus on isolating price, volume, mix, foreign exchange, cost, timing, one-time items, and forecast error. Quantify each driver, validate with operational owners, identify accountability, and recommend corrective actions. Question 6. How would you analyze the financial impact of a price increase? I would model the change from gross list price to net realized price after discounts, trade spending, and customer terms. Then I would estimate volume elasticity, competitive response, mix shifts, retailer acceptance, and timing. The key output is not merely higher revenue, but incremental operating profit and cash after lost volume, implementation costs, and possible share erosion. I would present base, upside, and downside cases with clear monitoring metrics after launch. Make sure to cover list price, customer terms, elasticity, volume response, mix, competitive reaction, trade investment, net sales, gross margin, market share, timing, and scenario analysis before recommending action. Question 7. What is your approach to forecasting demand for consumer products? I would combine statistical history with commercial intelligence. The analysis should reflect seasonality, category trends, distribution changes, promotions, innovation launches, pricing, retailer inventory, and supply constraints. I would compare the statistical baseline with sales team assumptions, investigate bias, and document the reasons for adjustments. Forecast accuracy and forecast value added would be tracked regularly. I would also use scenarios for uncertain launches or volatile categories, then refresh assumptions as consumer and retailer data improve. Discuss historical trends, category growth, seasonality, promotions, distribution, innovation, retailer data, supply constraints, statistical forecasts, commercial judgment, bias checks, and continuous learning from forecast accuracy. Question 8. How would you manage cost inflation and protect margins? I would quantify inflation by material, region, timing, and product, then build a bridge showing the gap to margin targets. Responses could include productivity, sourcing changes, packaging redesign, formulation alternatives, mix improvement, selective pricing, and trade optimization. I would evaluate consumer acceptance and competitive risk before acting. I would also establish triggers for additional actions, because protecting margin responsibly requires balancing short-term economics with brand equity, service, and long-term demand. In your answer, cover commodity and freight exposure, productivity, sourcing, formulation or packaging changes, pricing, mix, trade optimization, overhead control, scenario planning, and avoiding actions that weaken long-term consumer value. Question 9. Tell me about a time you influenced a non-finance stakeholder. In one role, a commercial leader wanted to increase promotional spending based on top-line growth. I built a simple analysis separating incremental volume from baseline sales and showed that several promotions destroyed profit after retailer funding. Rather than rejecting the proposal, I offered a redesigned calendar targeting higher response periods and products. The leader accepted the approach, and profitability improved without sacrificing sales. The experience taught me that influence comes from practical alternatives, not simply identifying problems. Use a concise star example showing how you built credibility, translated analysis into business language, handled disagreement, influenced a decision without authority, and measured the resulting operational or financial improvement. Question 10. How would you assess whether a marketing investment is effective? I would distinguish incremental demand from sales that would have occurred anyway. That requires a baseline, comparable markets or periods, campaign timing, distribution data, and controls for promotions and pricing. I would assess return on advertising spend, but also margin after investment, household penetration, brand metrics, and repeat behavior. Where attribution is uncertain, I would use controlled tests and triangulate multiple data sources. The decision should optimize profitable, durable growth rather than chase short-term volume. Be sure to mention incremental sales, baseline demand, reach, frequency, brand health, media quality, timing, margin after investment, test and learn methods, attribution limitations, and longer-term consumer effects. Question 11. What working capital levers would you prioritize at P&G? I would examine days sales outstanding, inventory days, days payable, and the cash conversion cycle by business and customer. Inventory deserves particular attention because reducing excess stock can release cash, but cutting too deeply may create lost sales or service failures. I would improve forecast accuracy, production planning, customer collections, payment term discipline, and obsolete inventory management. I would assign owners and monitor both cash and service metrics, ensuring working capital actions support consumers and customers. Focus on receivables, inventory, payables, service levels, forecast accuracy, production cycles, customer terms, obsolete stock, cash conversion, cross-functional ownership, and protecting availability while releasing cash. Question 12. How would you evaluate a new product launch? I would evaluate the consumer proposition and category opportunity first, then model distribution, price, volume ramp, mix, cannibalization, marketing, trade spending, manufacturing requirements, and working capital. I would calculate contribution margin, break-even timing, return on investment, and cash needs under several scenarios. The business case should identify critical assumptions and launch gates. After launch, I would compare actual trial, repeat, distribution, margin, and cash performance with the original plan. Talk about strategic fit, consumer need, market size, cannibalization, pricing, distribution, marketing, manufacturing capacity, launch investment, contribution margin, break-even, scenarios, and post-launch performance measurement. Question 13. How do you ensure accuracy and integrity in financial reporting? I start with clear ownership, documented processes, reconciliations, review controls, and evidence that supports significant judgments. I would pay special attention to accruals, rebates, trade spending, inventory, cutoff, and forecast estimates because those areas can materially affect results. If a treatment is uncertain, I would consult policy and accounting experts, document alternatives, and escalate promptly. I would never delay or obscure an unfavorable result to protect a target. Credibility is a finance leader's essential asset. In your answer, emphasize strong controls, reconciliations, documentation, review evidence, segregation of duties, policy knowledge, transparent estimates, escalation, audit partnership, and refusing to compromise accuracy for performance optics. Question 14. Describe how you would manage a forecast under foreign exchange volatility. I would separate transaction exposure from translation exposure and identify currencies affecting revenue, costs, and balance sheet positions. I would use approved rate assumptions, sensitivity analysis, and multiple scenarios to show the potential impact on sales, operating profit, and cash. I would coordinate with Treasury on hedging policies, while commercial teams consider pricing, sourcing, and mix responses. Reporting constant currency performance alongside reported results helps management distinguish business execution from currency movements. Cover transaction and translation exposure, currency assumptions, sensitivity analysis, pricing responses, sourcing, hedging coordination, constant currency reporting, scenario ranges, and separating operational performance from currency movements. Question 15. How would you handle a business partner who challenges your financial analysis? I would first understand which assumption or conclusion the partner disputes and why it matters to the decision. Then I would recheck source data, definitions, timing, and model logic, separating factual disagreements from different business judgments. If the challenge is valid, I would revise the analysis openly. If uncertainty remains, I would present both views with sensitivities and recommend a path forward. Constructive disagreement improves decisions when handled with curiosity, evidence, and respect. Make sure to cover listening first, clarifying objectives, checking data and assumptions, distinguishing facts from judgments, inviting alternative evidence, maintaining respect, reaching a decision, and documenting unresolved risks. Question 16. What KPIs would you put on a monthly management dashboard? I would keep the dashboard focused on decision-useful measures: organic sales growth, volume, price and mix, market share, gross margin, operating profit, advertising productivity, productivity savings, inventory, receivables, operating cash flow, and forecast accuracy. I would include both outcomes and leading indicators such as distribution, consumer penetration, service levels, and innovation progress. Every KPI should have a clear owner, target, variance explanation, and action so the dashboard drives management rather than merely describing history. Discuss organic sales growth, volume, price and mix, market share, gross margin, operating profit, advertising productivity, productivity savings, inventory, receivables, cash flow, forecast accuracy, and leading indicators. Question 17. How would you prioritize competing finance requests from senior leaders? I would rank requests by the decision's strategic importance, financial materiality, risk, deadline, and potential value of better analysis. A regulatory or control issue may outrank a useful but non-urgent reporting enhancement. I would clarify the minimum analysis needed, reuse reliable data, and assign work according to team strengths. If priorities conflict, I would make trade-offs visible to leaders rather than silently overloading the team. That approach protects quality and builds trust. Focus on strategic impact, urgency, decision value, financial materiality, risk, reversibility, resource capacity, deadlines, stakeholder alignment, and transparent communication when lower priority work must be deferred. Question 18. Tell me about a time you improved a finance process. I once inherited a monthly forecast process built around multiple disconnected spreadsheets. I mapped the workflow, eliminated duplicate inputs, standardized definitions, and automated recurring calculations while preserving review controls. The cycle shortened by several days, errors declined, and managers spent more time discussing drivers instead of reconciling files. I also documented ownership and trained users, which made the improvement sustainable. My lesson is that automation works best after simplifying the process and clarifying decision requirements. Present a measurable process improvement involving root cause analysis, simplification, automation or standardization, control preservation, stakeholder adoption, cycle time, error reduction, and lessons for continuous improvement. Question 19. How would you respond if a forecast missed target late in the quarter? I would quickly quantify the gap and separate committed results from uncertain opportunities. Then I would validate assumptions with sales, marketing, supply, and operations, build realistic scenarios, and identify actions such as correcting pricing execution, reallocating promotions, reducing discretionary spend, or improving production mix. I would communicate the outlook early, including downside risks and cash implications. I would not use unsupported accounting entries or harmful short-term actions. Credibility matters more than cosmetic target achievement. Mention rapid fact-finding, updated scenarios, controllable actions, ethical boundaries, cross-functional alignment, communication cadence, cash awareness, root cause analysis, and avoiding unsupported last-minute accounting or spending decisions. Question 20. What would make you an effective finance manager at P&G? I would bring 3 strengths: rigorous analysis, practical business partnership, and dependable leadership. I can turn complex data into a clear recommendation, challenge assumptions without damaging relationships, and follow decisions through to measurable results. I also value coaching because a strong finance team scales through capable people and consistent standards. At P&G, I would stay close to consumers and customers while protecting controls, improving productivity, and helping the organization deliver sustainable growth and cash. Be sure to highlight analytical rigor, business curiosity, consumer understanding, communication, coaching, accountability, cross-functional influence, controls, resilience, and a record of turning insight into profitable, sustainable decisions. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.